Hi. I wanted to show you guys this article that I think is kind of deceptive. So let's step into the library for a sec here. All right, so I'm trying out without the earphones on. I can see the levels, and I'm just gonna try it out and see how it works. And not always have earphones on. Anyways, yeah, I was checking back. MNK is one of the stocks that as I've said before, I'm pretty much the worst stock picker in the world. So don't follow my recommendations on stocks ever. I would always keep that in mind. MNK Malincroc. I came across it because it was the company that made the pills that I used to use when I was addicted to drugs. It's kind of something I don't talk about that much, but I was addicted to opiates, and I decided at some point to switch to a kinder, gentler drug than the street varieties, and I switched to this Malincroc product called M30 Percocet. Anyways, that was a long time ago. But more recently, I bought Malincroc, paid around $9 for it like a month or two ago, and I immediately, a few days later, sold it for $8. So that was a nice negative move for me. Let me show you here. All right, so you can see that down move just to the left of me. Okay, so I bought it for 9, sold it for like 8. So that was a bonehead move. Maybe it wasn't a full dollar, but I lost a little money on that one. But fortunately, did get out. And this is one of these stocks, like a lot of these opiate companies, that have gotten hit by lawsuits and stuff, and in a sense, rightfully so, because of their, shady marketing practices and they're trying to blame somebody for the opioid crisis in the United States. And as an addict myself, I think we need to take personal responsibility. I don't blame I'm not one to go out there and say, "Oh, the drug company made me take drugs. We should sue them." Of course not. It's not the drug company's fault. It's my fault, or it's a disease, all that stuff. Whatever. My point being that I don't personally blame MNK for my drug problems. However, MNK did manufacture one of my drugs of choice, so I keep an eye on the stock, and I was thinking, well, maybe I lost so much because of their drug, but maybe I can gain some back on the stock. Anyway, so I've been following it. Like I said, I lost money a couple weeks ago, but I keep following it. I pulled it up yesterday, and I found this trade here. Now, earnings is coming out at the end of August. August 8th. And if you look at the chart for like a year, it's basically like in the basement. And there's been rumors that maybe the stock might even go bankrupt. And I've dealt with bankrupt stocks before. It's not a fun thing. You say, oh, wow, it's the cheapest it's been in so long. I'll buy some. And then it goes down lower, and you're like, "Oh, I'll double up." Now I'm getting a great average price, and then it goes to 0. So I don't necessarily want to play that game too much. However, that being said, this looks like a possible opportunity here. I mean, the company is still making money. $2 earnings per share is something. It's not like it has no products, and it's not making any money. The company's making money, and they have stuff in the pipeline. They've got a bunch of lawsuit stuff going on, and I'm not going to get into that because it's pretty complicated. But anyways, I was looking through the news stories, and I found this news story from the 24th, and I was amazed, and I probably have a different take than a lot of people would on this news story. So if we just check it out really quickly, it says, and this is by Benzinga Pro, and I don't blame Benzinga as much as like just the individual author of the story, who I don't know who it is. Does it say here? No. But I just think that this is irresponsible as far as towards retail traders. I guess retail traders, look, educate yourself. Make your own analysis of things. All we have here is an options trade, and we never know what people are doing against options trade. Most options trades don't exist in a vacuum. It's not like, oh, they just put a trade on and that's it, and then they're going to take it off at a higher or lower price. No, most are part of a bigger strategy. Now, let's read this article really quickly and check this out. Okay, so short ideas. Already there's a bias there, right? Malincroft. Shares are down 32% year to date, but a series of unusual large options trades Wednesday morning suggests at least one trader thinks there may be even more downside ahead. Aha. The trades. On Wednesday around 9:46 a.m., Benzinga Pro subscribers were alerted to a purchase of 702 Malincroft put options at a 7 strike price that expire October 18th. Now, you didn't have to be a Benzinga Pro to be alerted to that. You just need to go on your Thinkorswim, which is free, which we have in front of us here, and you can check it out. So I'm not going to do that yet, but we'll do that in a second. We'll look at the time and sales. Within 1 minute, likely the same trader bought an additional. Okay, so what do we have? A guy came in and bought October 7 puts, paid $1.25. And this guy's like, wow, that's $87,000 bearish bet. Okay, so there's a lot of reasons why that's deceptive. But, okay, so then they came in and they bought another 620 of these puts. So that's another $80,000. So we've got $167,000 of put buying. At 9:50, a trader purchased 693 of the same puts. This time a price of 135.1. Now, how do you pay 135.1? You can't pay 135.1. So obviously, the person either doesn't understand trading who wrote this article, or it's just a typo. I'm going to give them the benefit of the doubt and say it's just a typo. Over the next 3 minutes, there were two more large October 18 Malincroft put option purchases. The first was 967 of the 5 puts, paying $205. The second buy was for 1,485 of the 7 puts at the ask price of 50 cents. Now, it appears that they got these two reversed, because why would you pay $205 for the 5 puts? Why would you pay more for the 5 puts than the 7 puts? Obviously, they reversed these two. What they meant to say was you paid 50 cents for the 5 puts, because if they were paying $135 for the 7 puts a couple minutes ago, why would they be paying $205 for a put that's $2 lower? So obviously they reversed these two. So the 5 puts never traded $205. The second buy was 1,485 of the 7 puts at the ask price of 50 cents. So they must have reversed these prices, because they don't make any sense. The two bearish bets were worth $198,000 and $74,000 respectively. Altogether, the traders bought a net of $534,000 worth of Malincroft puts within a 10-minute stretch. Options insight. Okay, my insight is that you reverse the prices of the 5 and the 7 puts here. You should proofread your article. A, and B, we don't know what somebody is doing against these trades, okay? So let's take a look just at the open interest, and then we're going to model these trades in our analysis tab and just take a look at them really quickly. Bear with me. We're going to do this very quickly here. So MNK, we'll pull it up. Okay, we're going to go to time and sales, and I'm probably not going to roll it back, but we'll just look and see what we've got going on here. And let's just take a look at open interest in these October puts. So I'm going to switch my tab to volume open interest. And okay, so October 7 puts, open interest of 7,000. So this wasn't a ton of the open interest. And you can see here that there is no way that these October 5 puts traded $2. No, it's the October 7 puts here, right, that traded $2. And my supposition is that they were buying puts with stock to turn this into a relatively cheap straddle. Now, if you look at the volatility prices, it says 100%. Wow, 100%, that's very expensive. But this is a $6 stock, so you don't want to look at the volatility. You want to look at the dollar amounts. And if you look at this, if you're buying the puts for they were saying the 7 puts 130, okay, and then you're buying stock below 7. So you're actually not paying even twice as much as you pay for the puts for the straddle, because you're buying, these puts are actually in the money. So let's model buying 1,000 of these puts just to see what it would look like on our sheets. And my supposition here is going to be that they are hedging these with stock. Now, we don't know how much they're hedging them with stock. They could be hedging them delta neutral, which is probably what I'd do. If you hedge these delta neutral, you have a good shot at making money both to the upside and the downside on a decent move here. If it goes bankrupt, you're going to make money to the downside because you're paying less than $3 for the straddle. And if it is going to go bankrupt, it's going to go down big, right? It's going to go to zero. Maybe not by October, but you're going to have some kind of big move. So let's see, 1,000. I think that's 1,000 puts. It's hard to see. So let's buy 1,000 puts here, and we'll model this. Now, they paid around 130. What did they say? 135.1. How do you pay 0.1? Let's just put it as 130. Okay, so you buy 1,000 of these puts. They're giving these puts a 42 delta here. You can tell that because buying 1,000 shows you short 42,000 deltas. So you could buy these puts, and if you wanted to hedge them delta neutral, I would think, for me, delta neutral, since these are almost at the money, I would say buy. If they were at the money, right? These are, I believe, these are 7.5 puts, right? When they say 7 puts, let's clarify that real quickly here. October. No, they're just straight up 7 puts. So if you were to buy 1,000 of these puts, if we were to hedge them delta neutral, that would be buying 42,000 shares of stock, right? And your decay is $700 a day. Now that sounds like a lot, but that's a lot of puts. So anyways, let's say we hedge this delta neutral here. So I'm going to say, let's say we buy what our sheets show us. We buy 42,000 shares. So buying the 1,000 puts would cost us, what do we say? $130,000, right? 130 times 1,000. And then buying 42,000 shares of the stock would cost us 42. I have 4,200. Hold on. So 42,000 would be 290,000. So roughly. So we've got basically like $800,000 in this trade, right? But the good news here is, let me add a 0 to this here. All right, so the good news here, though, is like, look, if this thing pops a little bit, let's take a look at our risk profile. And we'll move this down a little bit. So I suspect people are doing something against these puts, but it gives you opportunity to buy stock with confidence because you know that you've got this cheap straddle on. So look, this shows us break-even points here. I don't know why it's doing this. So these little percentage points. You know, I'm forgetting how to use this properly to fix this. Let me see if I can reset this here. Yes, thank you. All right, it's not going to let me reset it, but click chart for data. And I'm sorry I haven't learned how to do this better. So this is showing a break-even point here of, well, by the end of October, if you haven't scalped at all, it has to go to 10 or to 4.8 for you to break even, right? That's delta neutral. But, you know, an active trader, and you've seen this in my videos before, would scalp back and forth intraday all the time. You'd be trying to, if possible, what we talked about, that decay of $768 a day, we would be trying every day to scalp back and forth to try to cover that decay. And if you just do it delta neutral, look at the stock's been a pretty good mover, and it seems reasonable that you could cover this stuff. You know, look at these gaps. You know, any of these gaps are going to make you money. And I suspect that this person is buying maybe even possibly 1-to-1 against these. So if we're going to model buying stock 1-to-1 against these, which is basically just turning these into calls, if I personally wouldn't do it 1-to-1 because I would want some protection to the downside, but let's say you were to buy 100,000 shares against these. So that would get you long 57,000 of this, right? You buy 100,000 shares, you're long 57,000. And you get a move up, and your break-even point is 8.2. But obviously, you're gonna take heat to the downside both on your stock, and your puts. If you buy them 1-to-1, you're just turning them all into calls. That's why, like, for me, I think this is a bullish trade. I think the person was buying puts to protect their downside a little bit and buying most shares against it. So, the trade I would do if I was this institutional trader would be probably to buy, I'd say maybe 70,000 shares against these puts. And then if we model that, you're going to see, all right, so we have a break-even point to the downside by October of around 350. So if this thing does tank, you're going to you break even at 350, but the real play is to the upside here, and you're just looking to pop above 8.8 to break even by the end of October. But you just don't necessarily even have to hold on to these puts till then. They're not going to, this isn't a super risky put to buy because no matter what the stock does, they're not going to lose all of their value real quick, and you can get out of them at any time. They're dollar cheap. So I like to trade looking at a lot of different ways. But the most important takeaway for me is that this is not an obviously bearish play. It could be a lot of things, and you cannot tell from just seeing somebody bought these puts that it's a bearish play. So this article is deceptive, A, and B. They mixed up the price of the 5 puts and the 7 puts here. The 5 puts, there's no way they could be trading 205. And there's no way the 70 puts could be trading 50 cents. So, look at the chart here. Look at the options here. The 5 puts obviously are the 50-cent ones, and if they paid $2 for these 7 puts, that might have been aggressive. But once again, stock was lower, and they probably bought stock against them. The stock right now is and look at this action after the close. Is this people reading this article and puking stock? Because look, it didn't work out so well because now we're bid up into the open. So whoever puked stock down here at 613. Not a great sale, at least right now. I know, of course, we have the benefit of 2020 hindsight, so I'm not going to blame somebody, and like predict the past and say, oh, that was a stupid sale, because at the moment, maybe you didn't know what was going on. Like I said, this does have a certain amount of bankruptcy risk going on with this issue. Now, there are many people out there who know Mallinckrodt and the lawsuits and all that stuff a lot better than I do. I'm not an expert in that, and I don't pretend to be. I'm looking at the order flow, and I'm analyzing that only. So, come on, if you're going to come on and make comments saying, like, I don't know what the heck I'm talking about with this because I haven't researched it well, I concur with you. That's true, but I don't need to research it well to know these things that I'm talking about. Serious Many. Yes, that's Thinkorswim I'm talking about. Dave, is it possible that UVXY goes down to 0? UVXY will not go to 0 because they will reverse split the stock as soon as it gets consistently below like the $7 range. They will reverse split the stock. So every time it gets near 0, they reverse split it and they bring it back up. And then it continues to fall, getting closer to 0 all the time. But it's really not the same. UVXY is not the same. It's not a stock, you have to remember, first of all, which is most people know. But it's also, it changes all the time because it's based on these two futures and the average between them. And, a year later, the two futures it was based on a year ago are long gone, and there's new futures that represent it now. So it's a different vehicle than it was 10 years ago. That's why when you look at a chart of UVXY and you see, oh, it came from 20,000 or something like that, and you say, oh, wow, this would be wouldn't it be awesome if I got long this and it went back to 20,000? Well, that just can't happen. And part of the reason is the futures that it was based on when it was up that high are long gone. They no longer exist. they long since expired, and so there's no way really to get back there. Yes, UVXY could spike, but for it to get back to, like, quote unquote, its former glory when it was way up here, it's showing 2,780 on this chart. To get it back up to that level could never actually happen, because the futures that was based on back in those days are long gone, and all these things have happened since then. So UVXY could potentially spike even to like 100, but it's not getting back to like 1,000 or something like that. It could spike briefly to 100. From here to 100 would be a huge move, especially since volatility is not totally in the basement. But and now that the fact that UVXY is not leveraged 2 times, it's only leveraged 1.5 times, means that it's harder to really blow this thing out on a spike. So there's your answer there. BYND, after being up a little bit earlier pre-market, is now down, trading 228. It was up around 238, 239 earlier in the pre-market. Let's see if we can graphically illustrate that here. Yeah, there you go. Am I in the way? Let's see if I'm in the way here. Probably. Got up to 239, and now it's kind of tanking. Now, this is going to get squeezed again and again. People are going to try to short this, and then it's going to pop in their face, and they're going to be forced to cover. You're going to see it keep popping like that because people are so trying to short it. I don't know what's going to happen with this in the next couple of days. Earnings are today after the close, so you need to have your position tightened up before earnings. I would be careful with my position if I were you. It's weird how Thinkorswim is showing the position. It's like when this is up, like this is just before the open or after the close, it shows like the P&L changing for me as if I was really long shares. So if this is up $5, it shows me like making thousands of dollars. This is down, it shows me losing thousands of dollars. Now, that's not really my position. And as soon as the market opens, it corrects itself back to what it should be. But yeah, so UVXY, let's take a look. I just want to take a look quickly at a strategy which was outlined in the interview, which I haven't released yet, but was outlined a little bit in the interview. And that was to sell at the money calls in UVXY, like a week out. So you pick, right now UVXY 2382. So maybe you pick, and this is a risky trade, So you do this trade, you lose money. Don't come crying to me. This is a risky trade. I'm talking about selling naked calls right now in UVXY. So this is a risky trade. You could lose all your money on it. If you don't feel comfortable selling naked calls, I totally understand. But I'm just going to give you the information on this trade. And this trade, I would recommend doing very small if you're going to do it. But it would be pick maybe the 9 August options, right? And you've got the at the money strike or slightly in the money strike. We could pick like the 23 calls or the 23.5 calls, right? So you sell one of these 23 calls at $1.54, right? And so you've got a lot of things going in your favor. You've got decay for the options in the call. You've got, this in contango and all the beta slippage, all the things we talk about, why we like being short volatility. Plus, you've got the decay in the call. And when you've got just a naked call as opposed to a spread, it gives you more flexibility to kind of wiggle your way out of trouble. A lot of options trading is wiggling your way out of trouble. So if you sell this call, all right, so the break-even point on this would be 24.54. But what you do is you sell this call, and if it goes for you and this ends up expiring under 23, then you collect your money, trade's over. If this ends, this is in 11 days. And if in 11 days, if this is still above 23, you take the call, you roll it out to the next week. By roll it, I mean you buy that call back and you sell the next week's 23 call or whatever's at the money at the moment. And this way, you're going to be successful most of the time. If the call expires worthless, you keep the money. If it expires in the money, you just sell the same strike the next week out and you roll it out. And so you're just hanging out, and you're always short UVXY in a way that is most productive because you're collecting the decay on your calls plus all the other reasons why we like to short volatility. And you do this trade small so that it's just a small percentage of your account. So for example, you have a $100,000 account. If you sell 5 calls, let's say, it's going to take maybe 5 naked calls would be like $10,000 in buying power out of your $100,000 account. And those calls, this thing can pop up. You want to make sure that if this thing pops up 50, 80%, that you still have enough buying power in your account to weather the storm until it goes back down. So this pops up a little bit, you can roll the calls out, but you don't want to put yourself in a situation where this pops 10% and your buying power is gone, you're forced to cover at a high price. That's the way you lose in one of these things. The way you make money is you stay really small. You say, okay, well, I'm going to sell this 23 call for, let's say, $2. And each call you sell, you're going to, on the normal week in UVXY, when this expires worthless, you're going to collect that $200, trades over. You've got $200 more. You can go the next week and start selling stuff. If you do get that little pop, then you can roll this call to the next week's 23 call, and you just wait until it goes down, which it eventually always does. So that's an interesting trade in UVXY, and you'll hear in the upcoming interview, which I'm releasing soon, some other people using that strategy in UVXY. So thanks again for watching. There's all kinds of ways to make money shorting volatility. This is one that a lot of people have kind of grabbed onto after trying different things. The reasons that it's better than other things are, A, you're just collecting decay for the call all the time, and it's options decay the most right before expiration. So you're collecting the maximum decay for that call. And B, since it's not a spread, you can just roll this to the next week call if this starts to spike or go the other way. You can buy yourself more time by just rolling it out to the next week. And in that way, you can maintain your profitability. So what we're probably going to do is I'm going to start a small position, and we will just employ the strategy, and we'll watch and see how it works out over a little period of time, and we can watch it together. So maybe we'll start something like that today. All right, so the market opening is coming up. Once again, BYND earnings are between the close today and the open tomorrow. So you want to be set up for whatever position you want on to earnings. You want to make sure that you're set up right coming into earnings. And by set up right, I mean you don't want to be risking your whole account on earnings, because we don't know what's going to happen. Nobody knows what's going to happen. And it would be a pity to be making money for a long time and then just blow it all out, give it all back on earnings just from a random event. So keep that in mind, and I will see you in the next video. Thanks everybody for watching. Good luck today.